The term unprecedented times has been thrown around a lot lately. And here we are patiently waiting for our precedented times to kick in. We really thought that maybe a reset of the US government would really help us get there. But it feels like we've been sitting at the train station for a whole lot of long time, and that train ain't a coming. We're going to break it down today, and maybe we'll get back to some precedented times in the future. Well, that was about as jarbly as it could have been. I feel like that's like sort of the energy that's out there right now. There's a whole lot of start and stop. I think we're going to talk about that today. Certainly, I've
Hmm.
noticed, for my business, there was a real big influx of mortgage applications coming in, some purchases happening, and then it seems like it was slowed down again with this uncertainty, with the fear of the tariffs, or like the uncertainty of the future, where the interest rates are going, where the market's going. What's your, overall thought, overall energy? I think it's
Yeah,
weird
no,
right
I'm feeling it in a couple ways. I think we see that excitement of interest rates coming down and buyers getting excited. A lot of people who have been on the sidelines before are jumping back out. But we're going to get into this a little bit today. Of like, there's a lot of different micro markets within the greater market. If you look at, I find the data about Canada not very helpful. But if you look at the different individual neighborhoods, that's maybe a little bit more realistic on what you can expect in Toronto or in condos. And we're a
certainly with
Toronto
real estate,
podcast, right?
and following real estate headlines, if we look at Canadian averages, you're like, it doesn't make sense for your particular market. If you look at GTA averages, again, it seems like it doesn't, it's not really telling the story that you're living. It's only when you break it down to, you're right, neighborhood and then dwelling type, then things start to actually make sense when you look at units not moving. Well, if that's the one bedroom condo that we've been talking about, yeah, that's those aren't moving, but that doesn't mean that the whole market is crashed or not moving. So really
Right.
is important to look at the specifics of the data.
Yeah. And I was thinking, what you said in the intro about, waiting at the train station and people, thinking that a new administration in the US was going to change things. If people want that change, um, and the grass is always greener on the other side, but it feels like we've gone over the bridge and it doesn't feel like the grass is all that green from what we expected. And for anybody who's thinking, well, I knew it wasn't going to be green. Well, yeah,
Good for
and those
you.
that hoped it would have been green. I mean, yeah, I think we all hoped, and that was the looking forward of, we hope it's going to be different, and we hope that a new prime minister is going to make things different in Canada. But we're so absorbed in the U.S. ecosystem. We just need to protect ourselves at this point.
Yeah, and the US ecosystem does have a big impact. So it's not like we're chasing headlines for sensationalism. We're looking for, little markers of stability in the economy in order to kind of predict what's going to happen in the real estate and the mortgage market. That's what we're concerned with. We've seen a very, very stagnant GTA market that was on fire for such a long time. And that's what we
Yeah.
got used to. And that was the normal. I don't feel like this is the new normal. I feel like we're still in between. We've crossed the bridge to get to the
Hmm.
where the grass is greener. It's not greener. And then when we look back across the bridge, we don't want to go back to where we were for the last 30 months.
Hmm.
We're looking for, not like a restart, but we're looking for the stability, something nice and boring, less headlines, and more productivity.
Yeah, well, let's start there in terms of like a topic. I want to start with the Bank of Canada, because they came out this past week and said that U.S. trade war could crush our economy. So they're sounding the alarm on this. If they go ahead with broad tariffs on Canadian exports, we could see a weaker loonie. We'd see slower growth, higher inflation. Job losses, of course. And if Canada retaliates, they're saying that things get even worse. So how real is that? Like, is this, I mean, Trump saying that tariffs are on time, is this a threat? What do you think that happens for interest rates and the housing market here in Canada? And let's specifically even talk about the GTA if you'd like.
Usually we can predict this stuff with some sort of certainty, but I guess with that style of leadership, we don't really know. We've speculated on tariffs, and let's say that they don't actually happen, or there's some tariffs on aluminum or something like affecting one industry, and there's no retaliatory tariffs from Canada. Then I think that we're okay moving forward. I think that we'll see continued slow interest rate cutting by the Bank of Canada. The economy won't be turned upside down. It won't be so hot that we're worried about inflation. So I think that that will create the steady pace as long as this sort of tariff, and I think the tariff announcement would come as early as Monday of next week. So if there's no 25% tariffs across the board, which I think maybe now that there's enough time for his advisors to tell him that it's really terrible for both economies, that this doesn't give the United States some sort of big leverage or big leg up.
Hmm.
It's just going to drive inflation up there. From that economic standpoint, yeah, a trade war, I think that puts us in the worst case scenario, which is the stagflation, where the GDP, the dollar, the economy stinks, but inflation is high because the cost of goods are high. It sort of handcuffs the Bank of Canada. We won't see, necessarily lower interest rates. We're going to be stuck in a bad situation if that
Yeah.
happens. We're really
Well, and yeah, I mean, Alcoa Aluminum, big aluminum producer, they said if there's a tariff on Canadian aluminum, it would cost about 100,000 US jobs. So they start protecting themselves that way. There would be layoffs to such a major portion of, the car industry and, just a manufacturing industry in general, that you could see mass layoffs, not just here in Canada, but in the US as well. So I think initially we would see the Bank of Canada react. We would see them lower the policy rate, make things cheaper for Canadians to go out and borrow money and invest in the economy. We'd see the government of Canada jump in with programs to help Canadians who are affected by the tariffs. But I think that's all very short lived, especially the Bank of Canada lowering the interest rates. I see them doing that immediately, but then the cycle is much shorter than what it was in COVID, where we see interest rates go right back up. The Bank of Canada learned their lesson, well, hopefully learned their lesson from the first time, where you can't keep interest rates low forever. And they would have to go back up to start to battle inflation.
Now, I think that even it is important to note the difference between when the Bank of Canada cuts rates compared to the fixed rates. And because we've had 2.5 years of high interest rates dictated from the Bank of Canada, so on the variable lending side, I think it may have turned a lot of people away from variable rate mortgages, at least for like the short term, as in maybe the next 3 to 5 years. So what people are really looking for is lower fixed rate mortgages, which is not tied to the Bank of Canada decisions, which is going to put us in a tricky position, because even if the Bank of Canada cuts rates down to, where I've predicted the overnight rate at 2% or lower than that, I don't know that it's going to necessarily drive home sales right away, because
Mhm.
people may have a reluctance to choose a variable rate mortgage after just living through what 4% interest rate raise,
Mhm.
which has been sort of the stifling headline of it all. If there's massive inflation, there's predicted to be inflation in the US with Trump as president, the fixed rates are predicted to stay higher. So we're
Yeah.
not going to get that sort of that driving force, because last time when the Bank of Canada cut rates, we had low variable rates. We also had very, very low fixed rates, 2.5% fixed rates. That spurs home buying.
Yeah. For sure.
So
The immediate reaction is more homes being bought, a weaker economy, lower cost of borrowing, very similar to what happened during COVID. Even though there could be mass layoffs, there would be lots of people that wouldn't be affected by that. and they would start to jump back in the market. I just think that it's more short-lived. I think we get a bump and then it goes back down to where we've kind of been wallowing the last couple of years in terms of prices, in terms of cost of borrowing. But anybody that's been like sitting on the sidelines waiting for lower interest rates, that would be your opportunity. And I guess that could happen at the next meeting, the March meeting, if tariffs go into place March 4th, which is the current deadline. We could see the Bank of Canada react, right?
Yeah, they could. And I guess my concern is that it may not be enough. You know, people have been following the Bank of Canada very closely now for over 2 years. So just to see it take a minor dip with a variable rate mortgage, where you know that if it takes another hike, you erase that dip. I just don't, I don't know that it's going to bring, all the animals to the watering hole, uh, like it might if both variable and fixed rates come down. Because if you could lock in right now at a 3% fixed rate 5-year mortgage, that would spur
For
home
sure.
buying,
Yeah,
because
but
then you
that's
have that
not
5 years
available
of
right now.
security. It's not
Yeah.
available right now. So when we look at, if we want to put all our eggs in that basket of the Bank of Canada, I don't think that that's a good bet if you're trying to predict the housing market for the GTA.
Yeah, I agree. Okay, so a lot of people are hoping for that rate cut in March, but it seems like it might actually be off the table. So December's retail sales surged thanks to the GST holiday from the Liberal government. But does this mean that the economy is stronger than expected? And most importantly, will the Bank of Canada hit the brakes on rate cuts because of it? Is this short term? Is this longer term? What's your call? Is spending actually much stronger? Is the economy much stronger than what maybe variable rate mortgage borrowers are hoping right now?
Yeah, I think just have to throw this research, this data. It's like it's not worth a whole lot. We're not going to stay in a GST holiday. So if it spiked or if it
Yeah,
didn't
it's over
spike,
now.
right? Um, so that data, like, forget about that data. I don't know what to do with it. It's a blip on the radar.
Yeah.
I would look more towards inflation. I would look more towards employment, and then, like, is it too wishy-washy to say future outlook? Because the future outlook right now is not so great. It's a good time for a rate cut if you wanted to spur on the economy, to maybe pad it up a little bit before something, a potential threat.
I mean, it didn't affect my purchasing. I don't know how if you considered more purchases because of the GST holiday. So I think that there was just a stronger purchasing environment. I mean, I'm only looking at that from my own point of view. I knew there was a GST holiday. I just didn't know what it was on. And I know that they advertised it very well. It just never resonated to me. I just made the same purchases based on what I was going to be purchasing for Christmas anyway. I didn't think like, oh, I've got 5% more. I'm not being taxed 5% because of this holiday. I just went out and bought what I was going to buy
Yeah, I mean,
anyway.
could you? I'm sort of similarly aligned with you with my spending, and we're supposed to be. Just for the record, if anybody's watching this at all, we're mortgage brokers. We're supposed to be prudent. We're supposed to tell people don't do stupid stuff with your money, right?
Yeah, but did people do stupid stuff with their money over because of the GST holiday?
I don't think that you could buy an automobile with this
No.
GST holiday. So I mean, that would be the type of purchase that you would want to make if you knew that you were in the market for an automobile and you could save, 13% on a $50,000 purchase. So that would be a smart move to make. But if it didn't
Yeah.
apply to that, and I don't think that it applied to that, I mean, I spend most of my money just at the grocery store, so
Right.
I wasn't paying tax on food anyway.
Right. You
So
didn't
like,
pick up some extra chocolate because of chocolate was included? Like, did you pick up any extra candy or chocolate because you knew there was a GST holiday?
I like a good 78% dark chocolate, but
I'm 85 myself.
I like that. I like that.
Yeah.
Just take all the enjoyment right out of it. Just nice. I like an 85, but I settled on 78. But I eat 1 square a day. So what are we talking about? Am I going to load up? Nah, not really.
Yeah.
My spending habits stayed the same.
Yeah, no, and I think that's probably the majority of people. So what my argument is that yes, there was a GST holiday, but I just don't think that that was necessarily the driving force between the spending that we saw, the consumer spending. And so I think the economy through that is stronger. And I think that we will continue to see those retail spending numbers sustain, seasonally. Obviously, January, people spend less money than they do in December. So I'm not expecting December numbers to continue
Sure.
into January. But I think that we'll see stronger January, stronger February. Like, we won't see a huge dip in that. Although, people are uncertain about what they're doing when it comes to, are these tariffs coming into play? Is my job going to be affected? If I was in manufacturing, if I was in the car business, I'd be looking at, well, maybe let's pull back on the retail spending a little bit. But people aren't buying cars like they were during COVID. People aren't doing, go out and buying homes like they were during that period as well.
That's
So
right.
I think that people are those big purchases, as you mentioned, cars, homes, boats, probably. That's probably things that people are going to hold back on, which that money then won't go back into the economy, which is bad.
Yeah. Yeah. And I mean, it's probably like the Bank of Canada, with their interest rates, have been telling us to stop spending for a very long time. So maybe, I mean, the retail stuff, sort of whatever, small ticket items. Um, but with the Bank of Canada telling us to hold back on spending for a long time, that would tell you, why people aren't changing their buying behaviors. They got the message. They don't want to pay the high interest rates on the leases or the financing of automobiles. So that's going to lead us to a slower economy as well. We're
Mm-hmm.
in that juggling act right now, that balancing act with the Bank of Canada,
Yeah.
reducing rates. So I guess what is your prediction for the next meeting, which is March 10th, I believe. Is it March 10th? 12th.
I am predicting no rate cut on March 12th. I think that just with the strong retail sales, I think the Bank of Canada wants to keep some powder dry when it comes to future rate cuts if there is a tariffs come into play. I think March, whatever the next deadline is, will get pushed out. We won't see the same. I think it will just be a continuous threat. I think maybe we will get some tariffs, but not on the widespread. So I think that March 12th will come around and the Bank of Canada will do nothing at that meeting. What's your call on it?
Yeah, I mean that's where like the temperature check seems to be is uncertain. With all this uncertainty, maybe just leave it where it is. It's 25 basis point cut won't do much. It's not going to bring the housing back. I think we're going to look at the housing stats here in a second to look at
Yeah, I
how
got this
slow
next.
it continues to be. 25 basis points isn't going to make people jump off the couch and buy a property. So I think that it's safe. So I will say, yeah, 25 basis point cut will continue the gradual rate cuts down to, I don't know, we can go below 2%. I feel at this
You're
point.
saying below now.
Yeah, well, the other economists are saying, oh, maybe 2.5%. I'm looking to the future, and I'm saying this doesn't look so great.
Yeah. I think where we're at right now, so we've hit the prediction, was it CIBC, I think, said hold
Scotiabank
on.
was like 3%
That's right. Scotiabank's at
right
3. Here,
through.
let me share the slides here.
Yeah, this is a good one to come back to as well. As we move through time and this slide stays the same, to see how the other banks or lenders
Yeah.
were approaching this.
So Scotiabank is the one that said 3%
We're done. Yeah.
now and through 2026. They have got no future rate cuts going on. BMO thinks that we will stay at 3% through this quarter, along with TD Bank. And it's CIBC, National Bank, and RBC, at least previously, who said that we'd get another quarter point this quarter. Maybe they've revised this since we last thought, but other than Scotiabank, they all see at least one more rate cut happening, if not two. And RBC is all the way down at 2% with Vaughan Zawadzki
That's
as
right.
the other predictor of the 2% mark. So anyway, interesting. I think like right now, I think BMO, Scotia, TD, they're right on track with where the market is thinking currently. And maybe CIBC, National Bank, and RBC have changed it as well.
And CIBC, that's our friend Benjamin Tull.
Benjamin Tal, yeah.
Yeah, we love that guy.
There are other people there too, but
not so prominent in
just
the
no.
media space.
That's right. So, I mean, further to that, as you were mentioning, Toronto new home sales have hit a 30-year low. And the last time new home sales, so this is new construction, the last time it was this bad was 1990. And that was the year of a major real estate crash.
That's bad news.
Yeah. So December was one of the weakest years for new home sales, while 2024 was one of the weakest home sales for new home sales in decades, despite developers throwing incentives left and right. So what's going on? Are buyers just waiting on the sidelines, or is this a deeper issue? I've got an image to share for this as well. So why don't you give me your opinion here?
I think that there's good news there. And the good news is, if you are a homeowner right now, this means that with volume of sales and not not price of housing, if number of sales are down, that means that the properties are holding their values, right? And when we see I think there's some other charts that we looked at as well this week that this is average home prices are down, and that makes sense. When you have low volume, that means that the only volume that's selling is maybe distressed properties, people that have to move, not a regular market, right? So like a very irregular market. Home prices reflective of the low volume. So that means that we do still have a stable market. There's no housing crash around the corner that we can predict for pricing.
Yeah. No, I mean, we saw a big bump in 2021, which was the banner year for all real estate and mortgage brokers. We saw a lot of new home sales, and it was a lot more investors were in the market, a lot more people looking to live downtown or invest in downtown. And so I would think if we broke down these numbers, seeing the number of, potential new home investors, mainly investors buying one bedroom condos, that's where these numbers have gone. I think if there was a ton of new homes that were available, at least in the GTA, so this is the Greater Toronto area, like if we were seeing a ton of, 2-bedroom or 3-bedroom affordable condos or townhouses that were available, we would see a lot more new home sales that are happening. And that would have been sustained because that would have been for the end user. But right now we're seeing just a huge decline in that. I can't imagine it getting any worse than this. I would imagine we're going to see it bump up to probably 2023 levels in 2025 at some point. We've got a lot of new homes that are coming to market, condo wise. But if they're building, they got to build the right type of content for people.
Right.
They need, housing stock that families are going to buy.
Because these were traditionally speculator units anyway.
Yeah.
Now that we're seeing the mass exodus, of the speculator market, it will maybe take a little while to rebuild that and have it backfilled by end users, which are slower to come to terms with that. This is still good housing. It seems unattractive, so your best buddies are going to say, "Oh, don't buy that." Your best buddies aren't in the real estate and mortgage market; they don't know.
Yeah. Here's another one.
They don't have the 5-year outlook. They're not paying that much attention to the fact that nobody's building today, so that in 4 years from today, these are going to be hot items, hot units to buy and live in. So it's like this is a real uncomfortable adjustment phase.
Yeah, and be greedy when others are fearful. If there are deals, if you're in a position to buy condos in about 3 years from now, there's no new units coming to market. And so if you've got more, you can buy more. They're going to be cheaper now than they will be in a couple of years, just in terms of the supply that's available and the prices going up because people still need that type of housing. But now would be the investment time. It's a bit of a longer road to get there. But if you're in the market for buying one bedroom condos as part of your investment portfolio, now would be the time to do it. I brought up the new home. So this is the monthly new home benchmark price. As you can
Right. This
see,
is what I was talking about.
you know, yeah, coming off the peak from 2022 for both homes and condos, um, relatively flat for the last couple of years, but we're still like anybody that bought a condo in 2010, they're laughing right now. And if you look forward to 2035, 10 years from now, you're going to be laughing at an
For
investment
sure you
at
are.
that
If
point.
you look at the trend, even though it's down right now from its peak, look at the last peak and trough and how much it climbed from there. So it's not there's no sort of trend that we're worried about on the negative side that it will stay down. Um,
Yeah.
and the economics of all this makes sense. Rents are lower, mortgage payments are higher. So if you're buying for an investment purpose right now, um, already 5 years ago when we were at its peak, or 2021 when we were at the peak of the market, it was still basically you weren't going to be cash flow positive on that investment out of the gate. It was still
Hmm.
5 to 10 years where you were going to be either breaking even or maybe even down a couple $100 a month in the GTA market. So I don't know if everybody fully understands that, but buying an investment property in the last 5 years, the projection wouldn't be that you would be cash flow positive in the first 5 to 10 years until some of that mortgage balance came down. So right
Hmm.
now, it's you would definitely be in a cash flow negative situation month over month if you were to
Right.
purchase an investment. Now, if you were to purchase that to move into, you're in a great position.
Yeah, no, exactly. Like if you're, so the thing with investors now is that, well, it's not cash flow positive and there's no guarantee that I'll have my money back in 2, 3 years, like it was when we were having that big rise up in prices.
Sure.
So that attraction to, well, is this a for sure thing? Right. Because I've got to pay to make this investment. And it feels like to a lot of people that you're just throwing bad money after good when the prices are not going up. And it was an easy decision to make when prices were going up like
Rents were going
gangbusters.
up, prices were going up,
Prices were going up. Everything
interest
was going
rates
up.
were low, future outlook was rosy as it could be.
Yeah.
It's never going to end, right? Uh,
Yeah.
and then,
Never.
and this is a blip. When we look at that chart, it's not like we're down back where we started in the 1980s or wherever that chart starts out. So it seems like we've hit the bottom of the trough, which is a much less drastic trough than the previous one. So there's
Yeah.
not a whole lot to worry about, except for right now, if you're going to struggle to manage your day to day cash flow on this thing, it's probably not the time for a first time investor to start dabbling in it. You want to be a little bit more savvy. You want to have probably something else in your portfolio. That would be my guess on
Mhm.
that one.
Well, and I was also going to say, like, do you remember the financial crisis back in 2008, 2009? Like, if you look at 2008, you don't see that was a major, major disruption. You don't see that in now, and maybe this will look different in 10 years as well when these bumps
Sure.
that we're seeing now or in 20 years from now. Where's 2017? 2017, you see this big, massive, like at that time, that 2017 dip that we've got here around the $1 million mark, where it dips down a little bit,
Yes,
that
yes,
was a
yes.
major disruption.
It was.
So, and so I just think that this all flattens out the further that we go into the future.
And it's interesting that 2017, the condo and the freehold market moved the same, but in 2008, the condo market was still climbing during that period where the freehold housing took the dip. So
That's right.
interesting that they moved separately and then they moved together, and now they seem to be sort of moving together as well.
Yeah. Now a big difference is that for first time home buyers, they're now on average 40 years old. So I don't know. That doesn't seem like, when I think of a first time home buyer, I think of a young couple, and I'm 45. So 40 still young, right? 45 still young, but it's not really young for a first time home buyer, in my opinion. But now that's the average.
So, how old
Um,
were you when you bought your first home?
I was 27.
Well, that's
So
great.
yeah, I was super motivated to buy my first home and got in it. But other people in my age group and my friend group were buying homes as well. I wasn't the only one doing it. Um, but I'm guessing that people are. So what's your initial take on that? So I don't know. How old were you, Vaughn?
I was like 37, 36, 37. So it was
Okay, so you're
skewing.
closer to that.
Yeah, it was skewing older. And I find that, I take a lot of applications. I do a lot of first time home buyers, and we probably all do because it sort of makes sense. And I find it's not 40 necessarily, but definitely nobody in their 20s is making a purchase of a freehold property anyway. So
Hmm.
we're looking mid 30s, and it sort of makes sense. The focus has shifted culturally, I think, where people want more stability before they start a family. Even like we're seeing the age of starting a family, I think, is moving older as well.
Sure.
So all of that makes sense. But that's kind of if we want to take a positive spin on it, which I don't usually, but I do today.
Give me some positivity, Vaughn.
Is that, if the kids are worried that, oh, I'll never be able to afford a home because they're comparing it to maybe their parents or their grandparents who may have, like my parents would have bought their first home in their 20s, early 20s.
Yeah.
Um, it's just a different looking picture. So, the kids don't have to worry about turning 24 and thinking about home ownership right away. The average children are staying with their parents longer these days, but they're doing a
Yeah.
lot of saving. They're not irresponsible. They're not spending it all on avocado toast, it turns out. They're saving their money, and then they're getting into the market when they can. And that also makes
Culturally,
sense.
yeah.
It makes sense
Culturally, a
culturally.
lot different.
Makes
Yeah.
sense, and that could be precedented by the economics of it. Is, if housing prices are so high, and you need to have, a six-figure income to purchase a house, which was not always the case, then you wait until your career matures a little bit. Now
Yeah.
you can get into the market.
Well, yeah, and I think like living in your parents' basement and saving money, culturally it's a lot more acceptable than it was. Our grandparents were probably all out of the house by 18 and all working. Now people are going to school for longer. They're buying home, they're buying homes much later, but they're going to school, they're taking on more debt, they're doing more things, they're living their life and staying at home and maybe even supporting the greater family, which was different than what it was, even just a generation ago, where people just moved out and their parents were on their own basically.
Yeah.
So rent is also a lot more expensive too. So if you're going to rent somewhere, it's going to cost you a lot more to do that. Rent's not like a third of what buying a home was anymore. It's expensive to rent. And
Sure it
so
is.
that pushes you back in your age group as
In
well.
terms of savings, for sure, especially if you're renting in our market, you're essentially paying a mortgage payment. But people that are paying a mortgage payment aren't necessarily saving up for a down payment, as well. Like
Yeah.
if your rent is $3,500 a month, and that's your mortgage payment, where's your additional savings going to come from? So that will
Yeah.
slow down the process. for sure. And
Yeah.
also, younger people, when we saw this sort of like 25% reduction in borrowing power, you have to wait a few years until your income comes up 25%. So all this stuff like really does make sense from a financial numbers perspective as well.
Yeah. The other thing I was thinking is that, like, if they're buying a home, um, maybe they're rather stay at home and save up and wait until they're more financial stable than to go out and buy a one bedroom condo. And certainly not that many people are buying one bedroom condos now. But if your opportunity is that you can stay at home, a lot of people, I would think more people would be able to save up that minimum amount that you would need for a one bedroom condo. And let's say 10 years ago, that was $25,000 or less.
Right.
It would have been the income that would have been getting in the way at that point. Even 10 years ago, it was easier to qualify for more. So I think that people are saving. It's culturally, it's the type of housing that's being built right now, the ability to stay home. And who wouldn't want to stay home and have your mom do all your laundry for you? Like, if you move out to a condo, you've got to do your own laundry, you've got to cook your own meals.
Who wants to grow up at 35 years old these days?
Exactly. And the other thing we're finding is that homeowners are staying put more often. So, it used to be that people would remove every 5 to 7 years. If you could remember, I don't remember that, but that was the thing. And homeowners are now staying put for even longer. And it's up to 18 years now in Toronto, which makes a lot of sense. Like, if I think of like my neighbors, like I've lived in my house for 17 years. We've got, no, 18 years now. And we've got no plans on moving at this point. And a lot of my neighbors have been around me longer.
I mean,
I'm
there's
still
some.
the new one in the neighborhood.
Right, and we just covered some of the factors why. If you're living in a house and you're raising your children in that house and the children are staying longer, well, what are you not going to move and upset
Yeah.
that whole thing? So there's that cultural thing. Then there's also like the cost of land transfer tax. We don't really talk about it that much, but we're talking about like $40,000 on a $1.2 million house roughly. And that's a sunk cost. You don't get that back. Who
No.
wants to do that? Who wants to cough up 30, 40, 50 grand every 5 to 6 years
Right. More.
just
Yeah.
to get a new postal code? I'm not sure.
Well, we kind of went through that love it or list it game ourselves during the pandemic in 2020. We were thinking, okay, well, we need another bathroom. Our kids are getting bigger. We've got one bathroom. We're on kind of a busy-ish, not a busy street, but like not a main artery, but enough traffic on here
I
that we
mean,
think,
it's
well,
it's
maybe we could
getting
move.
busier everywhere. So
Yeah.
regardless,
So we started doing the math. I'm like, okay, well, if we were to move from where we're at, and let's say it's 1.4 million, to move to a quieter street with a house with the same number of bedrooms and another bathroom, we would need to spend another probably $400,000 roughly.
yeah,
And then we started looking at, well, okay, well, what if we just renovate where we're at? So that's just the cost of like a home that we were looking for would be $400,000 more. Not to mention the land transfer tax, which would have been probably somewhere around $70,000,
yeah,
and the cost to sell the home, realtor fees, was another $70,000.
sure,
So if we put all of those costs in place, that far, even though the cost of the renovation was eye-wateringly expensive, it was still much less than what it would cost to move. I
yeah,
think people are doing those numbers in their head. Okay, well, how can we make where we're living now? How can we make this work for the foreseeable future? And I think anybody living in the city of Toronto, particularly with the double land transfer tax, that's what makes it. People are not moving.
for sure. It's a very good, very prudent idea, and to not move and not to swallow that sort of that massive loss. That's really, it's not contributing to your family's better situation. It's a lot of money to cough over to the government to move.
Yeah,
And we're
exactly.
seeing that in trends in terms of like home renovation trends. We've seen that on the up. I mean, we saw some of that during the pandemic anyway, as people wanted to make their living spaces better to accommodate their working from home, to accommodate the fact that everybody's there all the time. Um, so, all the trends really do, if you want to call it cultural or economic, or, culturally economic. I don't think we have we've coined a phrase for, we've got socioeconomic, but what about culturally economic? We've uncovered a new trend, but that it all makes sense.
Yeah. Yeah, I think we'll probably continue to see more of that. I think it's just the cost of home ownership makes this very difficult for people to move. But I can't see that number going down anytime soon. I think next year it will be 19 years. The year after that, it will be 20 years. People are staying in their homes. Like it just will continue
Especially
to
in the
increase.
GTA, we have a mayor right now whose favorite word is tax, and he got elected as mayor on the platform of we're going to charge everybody more tax. So I don't think
Right.
that we're going to get into a better situation in the GTA. And once that tax is in place, even the next guy who comes up, who might be an anti tax, individual, good luck them saying, yeah, we don't want all this money that we're used to collecting.
Yeah. Yeah. Well, when we're getting services as we are, I mean, there's a lot of reasons for the taxes, but the speed and the snow being removed was spot on. All these extra taxes that we're paying goes to just snow removal. Being sarcastic, obviously. But anyway, let me know what. Let's end it there. Let me know. We would love to hear your comments. Feel free to comment on the episode, any of our clips that we put out, and obviously, if you like this content, please like and subscribe. And we're looking forward to making great content about mortgages and interest rates and the economy. And Vaughn, any final parting words?
No, you know what? I forgot to introduce us at the beginning. It was a. I think the energy matched sort of what's going on in the market right now. But yeah, Sean Humphries.
Confusion.
It's been a pleasure today. I'm Vaughan Zawadzki, and we will definitely see you again.